Good evening, everyone, and welcome. My name is Shelley, and in terms of format for this evening, I'm going to be talking to you guys for the next about 15 to 20 minutes around mortgage strategies and the key to making progress in these uncertain times. I'm going to be joined a little bit later in a panel format by a couple of Enable Me experts. So you guys are going to get to meet Jay and Sam from our wealth and insurance team, who are going to be helping me answer some of the questions that you guys have been sending in. So let's get into it. I have a new laptop, so I'm hoping that this all goes well. So far, so good. So, a little bit about me. Why would I be qualified to be talking to you today around key strategies for getting ahead and paying off your mortgage faster? Well, I've been around for 10 years at Enable Me. Feel like I've seen it all. I have coached all walks of life to getting mortgage free and in control of their money and to where they need to be long term. I'm a qualified financial advisor. I walk the talk. I never give my clients advice that I would not do myself. And people come to me sometimes for a dose of honesty, which I give out in spades. But actually, as a financial coach, my role is to help people optimize their outcomes to get ahead faster than the rate that they're naturally on track to do on their own. We want to move forward, and we definitely do not judge on past decisions. So tonight is all about making progress, not achieving perfection. Excuse me, a wee disclaimer. It's great that you're here and it's great that you're watching this, but the presentation is purely informational. It doesn't constitute individual financial advice. So I love that you're here and I love that you're listening, and knowledge is great, but taking action is actually where the magic happens. And often that's where a coach can come in to help. So we're going to have a little offer at the end for you guys to come and see us. So let's just get a quick pulse check, really, of where the room is at and who we're talking to today. Can you guys please indicate whether or not you are mortgage free? That would be amazing if you were, but I'm sensing you're not, which is why you're here. So if you could fill that out, and then we'll just get a read on knowing who we're talking to tonight so we can tailor our conversations. Hopefully we've got some results. Okay. So there's a bit of mortgage stress. It was the title of the of the webinar. So a lot of you do have more than 15 years, sadly, to go on your mortgage, 67% of you. So really focusing on how we can get ahead, beat that mortgage into shape. Okay, moving in. So financial security, why do we want it? For me, it's peace of mind. I know there's not much peace of mind happening out there at the moment. Being financially secure, to me, also is being resilient and building resilience, putting yourself in a position of strength when it comes to making decisions. Financial security can actually lead to financial freedom. It can lead to choices around the work that you do. And in my mind, money is just a tool. It's a tool to support the kind of life you want to live. So let's get in control and master your money and your mortgage. So at the moment, not a very cool world out there. There's wars, there are interest rates rising, there are flat markets, volatile markets, inflation is rearing its head again thanks to petrol. None of these things are anything that you can control, but it doesn't make you feel so good, does it? And I always think being informed is really good, and understanding what's going on in the world is great, but being paralyzed by the noise of that is not so good. So I always say that hope and a plan comes from focusing on what actually you can influence on the inside. So we're going to do a little bit of talk about money personalities and that kind of thing, as well as some practical tips tonight. So here's how you can do it. So get clear as your starting point on where you're at. If you have a house, what is it worth? If you have a mortgage, how much is it? What's the bit in between? That is your net asset position. Do you have a problem? And what is that problem that you're trying to solve? Is it a cash flow problem? Kind of common at the moment. Is it time? Are you running out of runway and you still have 15 years or more to go on your mortgage? Or are you feeling like you have a bit of fear around taking risk and wealth creating? Behavior habits and structure are far more important than predictions on what crazy world leaders might be doing in the outside world. So, looking internally at thyself, we always want to understand where we're starting from. We call that here at Enable Me your cash position. Do you have short-term debt? If so, likely you're sinking. Can't pay that credit card off at the end of each month. You're actually going a little bit backwards. Are you resilient? Are you one of those people that has a really good financial buffer and you're kind of feeling like you're flying? Or are you like most of us that are just living paycheck to paycheck? And we call that the floating kind of client. On top of that, where do you start and your cash position? What is your money personality? We all have natural money tendencies. For some of us, we tend to be at that more shopper end of the spectrum. And others, they get a real satisfaction from seeing their bank accounts lift. You might think that being a shopper is a bad thing and that a saver is a good thing. I beg to differ. I much prefer to work with my shopper clients. They're much better at the bigger picture. Savers are so consumed with saving, they do nothing. And there is an opportunity cost to doing nothing. So really understand, what is that tendency that you have? We can't forget about risk, because risk styles do differ as well. We get the safety kind of first people versus the growth focused type of person. Is that holding you back? So how do you mix those together? Are you sinking? Are you a shopper? Are you sinking because you're a shopper? And do you like to take risk, or are you more of that adventure inclination? So have a think about your money personality, because awareness of this is actually the first step to making better decisions with your money. So there are three things that you can focus on regardless of what is going on in this crazy world. The first one is what we call maximize your surplus. When I say the word surplus to my clients, they think, or savings, they say, oh yes, I save, Shelley. But I don't just mean money that you shift into a bank account and then shift back when you want to go on holiday, all right? I mean long-term savings. We call that your surplus. Buying a car and doing a big renovation, you may have to use your surplus for that. But things like holidays, tires, or the service on your car, things around the home, I would say that's your normal everyday spend. I want to know what you can save over and above what I call your operational spend. That is your surplus. And actually, your surplus is a really key number, because it's the number that unlocks what we can achieve in terms of debt reduction and wealth creation. Next step, we want to crush non-deductible debt. So for those of you, if anyone on the call does have investment properties, but they're mortgage-free on their family home, sometimes we actually leave some of the debt on your investment property. When we say kill your mortgage, we mean the home that you're living in, or if you're rent vesting, at least one house where you could live long-term when you don't want to work anymore. We then want to unlock and use your equity that you create within your home, or if you're rent vesting your investment property, to unlock strategic ways to grow your wealth. So these fundamentals actually work in both good and bad times. Remember, I've been around for 10 years. I've seen a lot of things happen over those 10 years. And we've had low interest rates, high interest rates. We've had low inflation, high inflation. We've had just the kitchen sink thrown at us over the past 10 years. And the fundamentals, guys, do actually stay the same. So maximizing your situation means having a habit of regular savings. Why would you have a habit of regular savings? Because it creates options. The tricky thing is, though, humans are famously crap when it comes to willpower. So it's much, much more important to have really, really tight money management systems. This beats willpower all day long. Savings, and I have this habit of saying, I say this many, many times, but it's so true. I could care less how much you save every week or every fortnight or however, whatever your pay cycle is. The habit of saving is so much more important than the amount you're saving. So if you're out there and you're thinking, what is Shelley talking about? There's no spare money at the moment. Start with $5, $5 a week. If you get a tailwind, you might have a mortgage dropping off. Up it to 10, 20, 50, 100, pay rise, get some international students, kids start paying board. You're going to get wins over time. Build the habit, and then the magic will start to happen. So, so important. I want to say that earning more is good because we want to earn more because then we could potentially save more. But you know, humans and how we behave, right? The more we earn, the more we spend, lifestyle creep. So earning more is good, but don't forget to focus on keeping some, what's left over. So we have this concept here at Enable Me we call fritter, minimizing your fritter. And so we have strategies around that. And I guess you could call it leakage or slippage sometimes, I say. It's a really important concept to understand. And fritter can happen across the board. And really it's like 1% here, 1% there, across the board. So it might not be one big thing that helps you to save an extra 15%. It's a million little things. So I get these people and they say, oh, I always pay my insurances annually and that's cheaper. It saves me money. I mean, that's great. But if you're not actually saving the money, what's the point? You might still be buying an extra coffee a day or too many takeaways or extra trips to the supermarket. So you really do need to look at where the money goes across the board and ensure that you have then the systems to make sure that those savings happen. So mortgage interest is a real big one too when it comes to fritter. And we think at Enable Me that on average people do fritter around about 15%. And that can actually be the difference between struggling and thriving. Think of it as controlling the outcome of asking for a 15% pay rise. If we all had the power to take that decision, we would definitely take that. So that's fritter. So we don't necessarily need to earn more. It's more the focus on what we can keep, cutting out those things that we spend our money on that don't make us any happier. So that's how we kind of work to maximize our surplus. A good way to do this, and we do this with all of the clients that we work with, is to track your spend. So you can use a tracker app. We've got a very cool one called MoneyFit. Really getting an idea of where the money goes and do you want it to go there? If you don't actually track your spend, if you don't focus on that, how will you know where the money is going? So tracking is a really good way to figure that out. So step 2, crush your mortgage on your home. We want to critically get you debt-free on your housing ahead of retirement. The quicker we pay the mortgage off, the less interest you pay to the bank, the more future flexibility you're going to have. This also creates opportunities to invest that may not have been there before. This is why you would want to crush the mortgage. Now, this is an ugly example of how much interest the banks would get. This calculation has been done on a principal and interest repayment with fortnightly repayments. These numbers show just the interest you would be paying on top of your principal repayments. On a 30-year term, over $500,000 of interest paid to the bank versus accelerating, finding that fritter, chucking it onto the mortgage every year and paying it off in even half or less of the term, hundreds of thousands of dollars. I preface this as an overly simplified example. We know rates fluctuate, personal circumstances change over time. Sometimes you can pay off less, sometimes you can pay off more over your life around children and things like that. But the purpose of this overly simplified, I can't say the word, slide is to show you the real impact of paying back that mortgage much faster than the bank wants you to. I know I'd be happy with another $453,600 in my coffers for retirement. Thank you very much. So plot twist, being mortgage-free is a goal, but it's also a gateway. It's a gateway to unlocking time or money, right? Time and ability to grow your wealth. And actually, it just creates more choice. So it's not the only thing, though, to get you sorted for retirement. We do still need to actually accumulate wealth ahead of you retiring. Getting mortgage free earlier buys us a window of time that we can create wealth before we want to stop working. So, unlocking equity, it's dormant potential if it's unused. When I say equity, the faster you pay your mortgage down, it's the difference between the value of your home and the quantum of your mortgage. So if we're not using that extra equity that we're creating by paying your mortgage off faster, you're missing out on a big opportunity here. It is unused and dormant potential. So when used wisely, we can actually accelerate our wealth creation, and I'm going to start talking to that now. We at Enable Me actually believe in the strategy more than the asset itself. So the different forms of investment. We want to make sure for our clients, when we work with them around wealth creation, they have an optimal mix of assets and investments for their situation. It is definitely not a one-size-fits-all approach. So there are many different investment vehicles out there, and none are universally best. The right choice depends on you, your financial needs, what you actually need to live the lifestyle you want to lead, your goals around what you want to do and achieve in life, and how long we've got, which we euphemistically call your runway. For some of us, we have slightly shorter runways than others. The investments should solve a problem, not follow a trend. So we want to have a good mix. So what we do know, though, is if you are cruising for a shortfall, and when I say cruising for a shortfall, if you have more than 15 years to go on your mortgage and you have less than 15 years before you want to retire, I can guarantee you're going to have a retirement shortfall. If you're purely relying on your KiwiSaver, you're probably still going to have a shortfall to live the same lifestyle you want to lead. So we help our clients to calculate what's the gap between our needs and what we call the retirement number and what we've got in our KiwiSaver and anything else that we have. If the gap is larger than 300,000, you're going to need leverage to bridge that gap. So this is just another illustration. This is 160,000 being invested in either a managed fund or property. Overly simplistic again, but it just illustrates the same growth rate, but two very, very different outcomes. The benefit of leverage, it amplifies the return. You don't use all of your own money. You don't put all of your own cash in, but you do get to keep the gains on the value of that asset. Property can also work because it allows control of a larger asset base at an earlier stage. So for my clients who are working really hard to throw the kitchen sink at the mortgage, it becomes an option for them to borrow using that equity created in their home before they're in a position to start putting money into funds and investing. So you can start getting going on property a little earlier sometimes. So for those of you there who have less of a runway, obviously, the earlier you start, the easier it is. But the shorter runways, we've just got to be more precise and more strategic. It doesn't mean you can't get there. We just have less time. Progress beats waiting for the perfect time. So I would encourage you, if there is a lessening runway and you're feeling that this mortgage is getting on top of you, we've got to act. You can come and see us and we'll help you act. At the end of the day, the best approach for you, it depends on how long you have. It depends on your goals, the kind of risk you need and want to take, your cash flow and how flexible you want to be. All of these things matter and feed into any good financial plan. We listen to our clients. It's not a one-size-fits-all solution. And time in the market beats trying to time the market. So we are at the point now where I've said enough. I think I've gone for about 20 minutes. That should leave us plenty of time for some questions. I'd like to introduce some experts into the room. So the first expert to help me answer questions is Janani Bhaskaran. She's one of our wealth experts here at Enable Me. Hopefully you can get your camera on, Jay. Perfect. Welcome. Thanks for being here tonight.
Well, thank you, Shelley.
Amazing.
Really good presentation. Thank you.
No worries. And the next person to jump on is Sam North. He is lucky enough to share an office with me. And he is one of our insurance experts. Welcome, Sam.
Good evening, team. Good to be here.
And the third person that I need to introduce is Carla Burns, who's going to be moderating our panel discussion and posing these questions
Thanks very
to
much,
us.
Shelley. Thanks everyone for joining us tonight. So if you've got any questions, by all means, drop them in the Q&A box or in the chat, and I can pick them up along the way. But in the meantime, I've had some questions through, and I've got some other questions that I kind of thought of that will be quite relevant to our conversations. But I'm going to kick us off because obviously the topic of conversation at the moment is all around kind of the financial pressures and the higher costs that are going on. And nothing is more topical at the moment than the cost of petrol. And I guess, Shelley, where I'd want to start, and it was a great presentation that you kind of covered, but what is the most common financial mistake that people make when they're trying to manage mortgage pressure? And then they're sort of focusing on all of those cost of living things that are going on right now, because I can imagine that it can get very overwhelming in terms of trying to make headway on that mortgage, but dealing with like that kind of presence of everywhere you turn at the moment, something else is going up, be it insurances, be it, consumables. That's where we've been hit really hard.
Yeah, we have. And it's always sounds worse than it might actually be. So I spoke to More FM, a million More FM breakfast shows last week around this exact topic. And my first comment is just calm the farm, actually, because what is the impact to you actually? It's super easy to read headlines and just start to feel overwhelmed and freak out. So don't freak out. Sit down and go, well, hang on a minute. Hang on a minute. How many litres do I have? Google's said family car. How many litres does this said family car take and hold? How many litres do I fill up with? And what is the difference on price to what I was paying before?
Yeah.
Then you can go, okay, it's 15 cents more or whatever it is, 30 cents more or whatever it is than what you were previously paying. Times that by the number of litres. And then think about how often do you fill? Some of my clients actually only fill up once a month. So the real impact to them is $30 a month.
Yeah.
Go and look at your online subscriptions. How many coffees have you had that week? Do you really understand what the issue actually is in real terms before you start freaking out and buying an EV? Because the cost of the EV, $10,000 or $20,000 more than your petrol car.
Yeah, which sometimes people start to make quite irrational decisions in that process.
Exactly right.
And so the other thing I think probably where people started to get concerned is that gonna, like we've talked about inflation a lot, and we've obviously talked about interest rates, and everyone loves to talk to us about the crystal ball about, well, what does that mean? There's been musings going around as are the interest rates going to go up? And, what does that mean in terms of paying off your mortgage faster? Because everyone's very, very concerned about interest rates, but is that something that you can control? And obviously it does impact your ability to pay off your mortgage, but is that where it's really all at? Like, is it all around trying to time everything to get the right interest rate? Or with the clients you've worked with, like what is the actual secret sauce in terms of paying that mortgage off faster?
Yeah, and it's the bit where people kind of start to like come in and they're like, I'm going to negotiate on these rates. I'm going to try and pick what's going to happen. I'm going to go long. My worst example of that, I think, was a 10-year mortgage. It's like 6.5%, something terrible. Anyway, so the biggest difference that you can make is the principal that you pay off on the mortgage. Forget about, of course we want to try and hedge our bets. For some of us, we choose to do some splitting. We choose to, but the real thing that's going to shift the dial is pay extra principal on your mortgage.
Right.
$1 you pay today on your mortgage is $1 that you don't pay compound interest on for the next 30 years.
Yeah.
So that is the thing that will always trump the ups and the downs of the interest rates, because we can't control it. We don't know what's going to happen in the future. I love it when my friends text me and go, how long shall I fix my mortgage for? I'm like, I need more context. And I don't have a crystal ball. So let's focus on what you can control. Find that fritter, put it towards making extra principal repayments on your mortgage every year. That will trump interest rate fluctuations all day long.
Yeah,
hundreds of thousands of dollars.
Yeah, no, that's really good advice. And so the other thing I would sort of talk about just really quickly is that obviously, and then we will get to Sam and Jay, but like obviously, like lots of life events happen. So we've talked about those kind of life events that we can't control, outside of our control, like, you know, what's happening with prices, etc. But what happens when you've got life events that are kind of, you know, like we talk about the big ones, but the ones that are closer to home. So, you know, things get disrupted because things happen with your car, or there's those things that disrupt what's happening in your life.
Sense.
How do you,
Yeah,
yeah, or, you know, like you have to get your teeth done or something like that. Like,
always.
how do you plan to deal with those sorts of like extenuating circumstances in terms
Yeah,
of keeping track? Because I guess people's concerns are that like with expenditure being higher and your mortgage still being quite high, there doesn't feel like a lot left. Like, how do you encourage people to kind of have that bit left over to cover those incidentals, etc.?
yeah. And like I would argue that cars and teeth are like death and taxes. There will always be an unexpected bill. It drives me
Yeah,
nuts.
yeah,
We have to expect to have a dental bill. We have to expect that there'll be a car bill. Sometimes that bill is crazy high, but it's such a common thing that you're describing. And people always say to me, like, we were doing really well, and then something always happens, something always comes up. We
something
have to
always does come
expect that
up.
the something will always come up. If you have
Yeah,
a pet, it is likely there'll be a vet bill. So we need
yeah,
to be building in that contingency within your spending plans. So, you know, we know
right.
what comes in the door. I mean, I'm talking about getting a budget here. It's kind of boring, but, you know, we know what comes in. You
Yeah,
know what your income, well, some people don't, but figure out how much comes in the door every fortnight.
yeah,
We know what the fixed costs are. Let's anticipate there's going to be some form of cars, teeth, pet
yeah,
spend, and we need to be setting that aside. And that's, you know, we've always got to operate from a place of financial resilience. That's really, really important at times like this. But again, fundamental, right? We've got to have a buffer, 6 months worth
yeah,
of your spend accessible to you. When we work on having a mortgage, we can embed that into the mortgage structure. If you don't
yeah.
have a mortgage, we have it in the bank or whatever, easily accessible. But I think we
Because
need to be preparing for and
yeah,
assuming that those things will happen and set up the systems so that you're holding that money somewhere where you can access it if you need it and it doesn't become,
yeah.
oh, you know,
Because people are pretty good, I take it,
surprise.
of having a buffer to pay for their holiday, but you've also got to have a buffer to pay for if the
Yeah.
bad things happen as
Yeah.
well.
You might
Yeah,
like to have, we don't massively encourage this, but for some, they will have a holidays account. You know, there'll be a car and teeth account or something.
yeah. Gotcha.
The savings, and as I was alluding to earlier in the presentation, the savings needs to take into account that we are leaving a little bit behind for those
Yeah,
unexpected that always do happen. If it's not
yeah.
one, it's the other.
But then there's the other type of thing that we need to plan for a bit more. And Sam, this is where I'm going to loop you in, because we talk about life changes that you know we need to kind of financially plan for, but there's that also piece where there are things that we sometimes kind of risk plan for just in case they do happen, and those are things that kind of, I mean, teeth is something that you can kind of cover, but mainly it's things around your health, and also, you know, what if something does go wrong. And for those of us who have a large mortgage, you know, what type of insurance becomes really essential when you're dealing with like your mortgage and your financial responsibilities? Because for a lot of us, that mortgages aren't small these days, and if something's to happen and you lose that ability to pay your mortgage, you know, what sort of things should you be thinking about?
Yeah, totally. There's a lot of mentality around she'll be right or it won't happen to me. And unfortunately that's really dangerous. And we do unfortunately have to assume that at some point there will come a time where we're going to pass away or we're not going to be able to work due to illness or injury. And we do have to be prepared for that, prepare for the worst case scenario. And that might be something relatively minor or it might be something really, really serious. So ensuring that we've got life insurance in place if you were to pass away or income protection in place to ensure that you can continue paying those expenses and continue paying for the mortgage is just super important.
Yeah. And in your experience, like what are the common gaps that you see people sort of leave, where do people tend to leave themselves exposed when they're carrying mortgages that they're trying to pay down? Because we all know that sometimes it feels like an expensive thing to have in place.
Mm, for sure. Yeah, the main thing that I'm seeing all the time is just people being underinsured, especially with life insurance. Life insurance objectively is pretty cheap. For most people, it's not a huge expense, but it could be the difference between, your family being able to stay in the home that you're in at the moment, or potentially having to sell it and move to a low cost area. So ensuring that you've actually got the right level of cover in place is something that most people don't take into account too much, unfortunately.
Yeah. And so the life insurance obviously then protects you should you be in a situation that you obviously pass away. Just you want to explain a little bit more to us why income protection is also a really helpful thing to have in place as well? Because I think life insurance is something, as you said, definitely worthwhile should you be left in a position where you pass away and you want to pass on the house to your family. But I think equally, like one of our greatest assets is our ability to earn an income. And sometimes we kind of forget that. Like, I think sometimes if you're the parents of children, you sort of think, well, I wouldn't want my children to be left without a home. But it's the situation whereby you actually can no longer earn the income and actually you're still here. So, do you want to just explain a little bit more to us about that as well?
Yeah, totally. If you add up your income for the next, 10, 15, 20, 25 years, depending on how long you've got until retirement, that's way more than any physical asset you'll ever have. So ensuring that we've protected that is pretty important, because then there's the other assets we'll have, like our home,
Mm,
um, and like our vehicles and like our investments, that we probably don't want to get rid of if we needed to. So if you have the correct structure and the correct form of income protection in place, it means that if you couldn't work for an illness or injury, then you're going to be able to retain that home and continue to pay for the mortgage and keep a roof over your family's head. I've got a mortgage, I've got kids, so I've got income protection and life insurance, because I understand that if anything happened to me, my family wouldn't be able to stay in the home that we're in. And God knows what happens if the worst happens to me, if I didn't have cover in place.
yeah. And so, Jay, we'd also talked earlier about the fact that for a lot of people, your background is wealth, and we've talked a little bit about KiwiSaver and the fact that for a lot of people, increasingly so with KiwiSaver having been around for 20 years or so, there's an increasing number of people where they have sort of depleted their KiwiSaver to use it as their first home deposit. Not everyone with us tonight, but there'll be a portion. Do you want to explain why it's really important to get back into the KiwiSaver game as quickly as possible and start rebuilding that journey, and what the recommendation is around kind of contributing to your KiwiSaver after you've kind of done that removal for your first home?
Sure. With the KiwiSaver space, it's very important, as you said, if they've used it for their first home, then restarting it to build it for their retirement. Yeah, that's very important, because they get the perks of employer contribution and also the government contribution that gets put towards your KiwiSaver, towards your retirement, and these all aspects gets compounded and it gets invested. So, this is other sorts of wealth building towards your retirement. Alongside, while you're paying off your mortgage, you can still focus on just putting in as much as your employer is willing to do. That will build
Yeah.
a really good amount of wealth towards your retirement.
Yeah, and
Yeah.
if you've kind of done that home purchase and you're sort of at the moment, I think Shelley, it's about 36. I think the average age of buying
Mm,
your first home.
in Auckland,
Even
yeah.
if yeah, if you're repurchasing and restarting that KiwiSaver at sort of like that 36, that's still giving you 30 years of compounding on that KiwiSaver, which is pretty key, and it's really good. You and I had a chat, Jay, that it's really good as you come up. Like if we've got anyone on with us tonight who hasn't yet bought a home, and I think we had some people with us, it's quite useful to have a conversation with your KiwiSaver provider before you kind of go into your first home withdrawal, because you can kind of think about changing your strategy. Do you just want to explain that a little bit, Jay? Because the fund you're in, your strategy may change a little bit as you get close to that withdrawal.
That's correct. That's very right. So if you're planning on using your KiwiSaver to buy your first home, then the goal is different than retirement. That's going to be a shorter time frame. Then you've got to review your funds and look at more conservative option, because at that point you wanted to use that KiwiSaver money towards your deposit. So you essentially you wanted to protect the capital. So you wanted to protect that the money you've got in KiwiSaver, how much ever you might have. Some people might have like 20 or 30,000. So you don't want to see that money fluctuate more. So going more conservative for your first home, if you've got a shorter time frame, that's very sensible move. So thinking about what strategy would fit, what's the time frame you've got, what the end goal is. So talk to your provider, just reach out to us or like anybody who can talk about what strategy would be suitable according to your goal. Again, once you finish purchase your first home, and it's very important for you to go back and revisit your KiwiSaver and see where your fund choices are. You cannot leave that
in conservative.
In conservative, because that's not the right strategy for the retirement goal. Then you've got, again, as you said, 15 to 20 years before you can access your money. So then you wanted to look at more growth options or more aggressive options or strategies that would fit for retirement. So it's very essential to review your KiwiSaver when your goal changes. That's very, very right.
So that's a fantastic piece of advice, which is that if you are using that KiwiSaver and getting really close to withdrawal, it's one strategy. And if you are going back into your KiwiSaver after withdrawal, excuse me, so much excitement. It's a different strategy. And quite often what we find is that people start rebuilding that KiwiSaver after the withdrawal, and they're still on the old strategy of keeping it conservative, and you're kind of missing out on a trick. So it's really important to go back and get that advice and make sure that it's working for you. The other thing, and I'm going to throw this back to you, Shelley, and we'll bring Jay in, but there's always a question, right, which is that we're talking about how to pay off that mortgage faster, but should being mortgage-free be your top financial priority, or are there situations where you can be doing like this, paying off your mortgage, but also thinking about strategies to build wealth at the same time? Like, do I have to be completely mortgage-free? Because that was kind of my approach. And then I was like, I have to be completely mortgage-free before I do anything else. But can I be doing the mortgage-free and also thinking about some wealth creation at the same time?
I mean, yes, if you're looking at leveraging to buy something else. So like I said earlier, tapping into the equity in your home to buy something else, usually that's property. But it's always a question that I get: should I contribute to KiwiSaver or something else, or pay the mortgage off? And the annoying answer is it depends on your situation, because, how long is your time frame? What is the term on your mortgage? We generally, the answer is let's smash the mortgage out as quickly as possible. We do get people sometimes where they're contributing slightly higher to the KiwiSaver than their employer is contributing. It's not to say that's a bad thing. That money is being captured. It's going to compound beautifully for their future. But what if their goal is to retire early? Hey, you can't access that money until you're 65 in your KiwiSaver. So, generally we match what the employer is giving you. If there's a government contribution in the future, we get what we can get, and we focus on accelerating down that mortgage. Some do like to build a managed fund at the same time off to the side. That's okay, as long as we can still get a mortgage acceleration strategy that still puts you ahead of retirement. So it makes them feel a little bit better if we can be kind of doing our KiwiSaver, accelerating the payment down of the mortgage, and we're doing something else that's not got that locked-in KiwiSaver period to it. So to a smaller extent, though, and we've got to make sure, again, with their situation and their time frame, that it can all be achieved. Because if you're not prioritizing paying off your mortgage at all and you're building up investments on the side, that's cool. But if you get to 65 and there's still a mortgage there, they're going to have to pay off the mortgage anyway.
Gotcha.
So we want to get you mortgage free on a place where you can live, that you're happy to live in. But, everybody's different and they have extenuating and different circumstances that they're operating
Absolutely.
within. So
Yeah.
we
Yeah.
tailor that advice
Yeah.
accordingly to pretty much from that first session in terms of what we think they should be doing.
Yeah.
So it
Yeah. It's
depends,
hyper personalized.
is the
And
answer.
so, Jay, do you just want to explain to those that are with us, like, what is one of the advantages? Like, so KiwiSaver, as Shelley said, you're locked until 65, but what's one of the advantages of actually using a managed fund as a kind of differential there?
Yeah. That's a very good question. So as Shelley said, finding a very sustainable amount is the first key thing to put into a managed funds. So keeping a habit of doing a regular contribution and managed funds, obviously you don't get that locked until 65. That's the huge advantage, apart from what we have in KiwiSaver. Because KiwiSaver ideally is a managed funds, but it's locked until 65. It's governed with the KiwiSaver law. It's for purely for retirement, and you get the perks of employer. But managed funds, obviously, it's just your money compounding, and you'd be paying the fees on it. So it's diversification. So one of the key things with managed funds, you're diversifying asset within all the asset classes like properties and all the term deposits and all shares and everything. So it's professionally managed, and you're building your wealth alongside with paying off your mortgage, as Shelley said, and also having a retirement buffer with your KiwiSaver. Then again, it can sometimes manage funds can also act like an emergency fund if you don't have one. So this, it gives you a habit of putting in money. It's nice to see you've got another investment going on the side, and some of my clients use that as college fund for their kids.
Yeah.
So,
that's a great idea.
Yeah. So, and also they help them with their first home. So that's something outside of their own financial habits. They've built something that they can use in the future. So again, this managed funds also depends on the strategy. How long do you want this money to be invested? So how long have you got? Then you choose to be whether to go conservative or to growth, or aggressive strategies. Depends on your time frame and how much you can do. So as Shelley rightly said, like a little should be good to start with, and then as you build up more free cash or buffer, then you can add more towards your managed funds, like you do to your mortgage. So the more free money you can direct it towards your managed funds, and it's nicely diversified. Now you've got a property, you've got an emergency fund, or your managed funds, and then you have your KiwiSaver for your retirement. Then you feel, bit in control. That's what I would call.
That's great.
Yeah.
And Shelley, there's lots of ways to build out that strategy, property investing, managed funds investing. It just, it's lots of options.
Leverage. Yeah.
So Sam, I'm going to come back to you. I give you all the cheerful topics. We've kind of talked about the insurances and why private insurance guys, they always get the short end of the stick because you guys specialize in all things that are not so pleasant. Because one of the other things that I think is always worth talking about when we talk about mortgages, KiwiSavers and houses and all the rest of it is that the importance of having wills in place is really key as well. And so obviously the team and the insurance advisors often talk about the importance of having a will in place to protect your assets, your legacy, and just everything that you've had in place. And Sam, that's also really important around insurances as well, isn't it? In terms of like what's going to happen if particularly a life insurance pays out. Do you want to just explain a little bit around that?
Yeah, totally. It's as you say, it's not exactly cheerful most of the time. Unfortunately, it is tough conversations to have, but they're some of the most important you will have. So, with wills, I recommend everybody get a will, and an EPOA as well, and an enduring power of attorney, which essentially allows somebody to have either medical or financial authority over you if you can't have it yourself. And having those is super, super important because your life insurance and your KiwiSaver, I believe it's over $42,000. If your KiwiSaver is above that number, then it'll go to probate if it's not in the will. And then you're getting lawyers and it's drawn out and it's a lengthy process. If you have a well-structured will in place, then your assets, including your life insurance, is going to be divvied up the way it's supposed to be and the way you want it to be. So everybody should have a will as far as I'm concerned.
Yeah. Yeah, no, fantastic advice. And thanks for looping in about that around the KiwiSaver. A lot of people don't appreciate that when your KiwiSaver gets to that $42,000, it is also eligible to go into probate as well. So it's really key when you've got most people only think about a will once they've got a property or they've got children, but they don't realize as soon as they've got a KiwiSaver or life insurance or any of those things in place, it's really, really key. And really hard for us to see when people also have little people around and they haven't considered that process. So it's really, really key that you kind of contemplate that. Look, we've had some great questions there. I'm going to wrap up with a couple of questions, which is, Shelley, what's one financial habit that you think makes like the biggest difference in terms of becoming mortgage free faster? Because you've dealt with a number of clients.
What's one?
Sort of the habit that you've seen clients sort of in so many, getting so many clients mortgage free. What's one financial habit that's really made a big difference in that process?
I would say the systems, like getting the systems nailed. And actually, Carla, it takes time to do that.
Yeah.
I see a lot of different people, a lot of different family constructs blended, second time round. There's lots of different permutations these days in terms of the modern family. And so understanding that the systems kind of support you living your happy life and they're automated so that you can automate the savings. That's the key bit.
Yeah.
So we kind of spend the time with our clients to take the time to make sure that their systems are set up so that they can run their life really smoothly. When we talk about getting a habit, and James Clear from Atomic Habits always talks about reducing friction.
Yeah.
So making sure the systems don't have too much friction around that ability to save. So it's got to be automated and it just has to happen. You pay yourself first. So we need to take time, though, to get the systems right, because for some people they save too much and then they have to bring it back and that system doesn't work for them. So it's everything around that savings transfer. So covering bills and making sure they're, accounted for. It's building that buffer for the cars and the teeth, and then figuring out the exact number that you can automate going off into savings or debt reduction. Is the most important habit to have. And it's not just one that you can easily pick up. So it takes sometimes all year with my clients to actually build up
and it
habit.
has to keep, and it actually has to be like I completely agree with you. Like the money fit tracking or the tracking process works really, really well. And paying off a mortgage isn't something that you're going to do within a year, right? Like you build those habits and it has to you have to kind of keep going back and rechecking, and the plans have to keep iterating as your life changes. And that's kind of some of the benefits of being coached along the way. Yours truly might have been told off. Yeah, like you may have recently been told off by a coach for saving too much. So getting that balance right to kind of go in the right direction is
such a thing to be saving too much. Who would have thought?
Saving too much, like using the money.
We sometimes tell you to save less.
I know. Well, the funny thing is, it wasn't until I came to Enable Me that I discovered that there is such a thing as using money in the wrong way. Who knew it? But there you go. It's making your money work for you, I guess, is the thing that I have learned. And I think that that's a really good one, which is that the systems really help you, and then before you know it, it's kind of working for you. And that is
no
really,
guilt about the money. Once we know the savings is happening and it's long term and it's habitual and it's doing it. If you spend everything else, cool. Because we've calculated that the amount you do send across to getting mortgage free and investing is going to get you there where you need to be long term.
Sorry about sneezing. Sam, going back to you, like, what's the piece of advice that you would give to people as they're in this phase of the journey? Like we've talked about protecting yourself in terms of income protection. We didn't really touch on health protection, and there's also kind of protecting your assets, which we didn't really touch on either. But there's actually it is a time of like, there's a lot of things to be protected, and a lot of people kind of question the value of insurance at this phase of the journey. But what are what's that one piece of advice around the importance of insurances? Because I think you guys get to see the gnarly end of when it isn't done. And the weird thing is it's actually the opportune time to do it, right? Like if you're going to take out health insurance, the best time to do it is when you're in that 30s, 40s, best time to do income protection is then. The best time to kind of get all your house and everything done is in those early stages. Why is it so important to protect your asset and yourself in this phase?
Yeah, I spoke to a guy recently. He's a business owner who ended up selling the business, and then within a few months after selling the business, unfortunately injured his back quite severely and isn't able to return back to work, which um, who would have expected that? And yeah, he's getting ACC, but that's based on, his previous earnings, which are different to what his earnings are now because he's not earning anything. So that in itself is complicated enough. He did have income protection, but it wasn't structured right, meaning he's not going to get paid anything. But he was relying on the fact that he had income protection in place just in case anything like this were to happen. And I see that a lot with people that have got policies that have been in place for a long time or were set up originally through a bank. It's really good to have income protection in place because if we can't work for unforeseen circumstances, then you can still pay for your expenses. But the most important thing that everybody needs to do is talk to a professional in the industry like myself who can actually advise when you are and are not covered because you may unfortunately be surprised.
Yeah, yeah. It always pays to check, and that's a really simple thing to do.
Yep.
And Jay, like for people who are wanting to kind of, think, paying off your mortgage is a really key thing, but it's still an important time to build wealth and think about your wider retirement. And so what would your piece of advice be during this phase of your kind of financial journey? Like if there's one thing you should be doing, what should you be thinking about for your wider kind of plan for your retirement during this phase? Even if you can't do a huge amount, what should you be doing?
Sure. If they've already purchased their first home and they're planning to pay off their mortgage, they should really look at what fund they are invested in their KiwiSaver. Being in the right fund makes all the difference when they retire. So I basically see lots of clients who wished they could have seen me sooner. So get on top of your KiwiSaver, keep the habit of matching your employer. That way you can, just putting in the default amount of what you could do, and keeping a habit of investing in KiwiSaver is very, very important. So you're building that retirement buffer when you get to 65, and then being in the right fund, if you've got 10 to 15 years of time frame, is also very, very important because that makes all the difference when you retire. So yeah, just keep the habit of KiwiSaver, put in the default, match your employer, and it's all going to compound together. Just make sure you're in the right provider and the right fund.
Yeah, that's a fantastic piece of advice. Yeah, I'm starting to see some of the research where a lot of people don't even know who their fund is with. So I think it's really important that we take ownership of that piece. So yeah, look, thank you for everyone who has joined us tonight, and thank you to our panelists, Jay, Sam, and Shelley. That was fantastic. We have the ability, if you'd like to come and see one of our team, you are more than welcome to do so, and we'd really encourage you to do so. So what you're able to do if you'd like to is come along to a financial consultation with one of our Enable Me coaches. They're able to give you a full picture, and as Shelley was kind of talking to you, work with you to look at what's happening with all of your spending and kind of work out any inefficiencies, and certainly talk about that mortgage structure and your investing trajectory. And we do that through a sort of 90-minute consultation and then build out an overall plan. And so there's no obligation around that. And if that's not right for you, then we'll certainly give you some ideas as to where to go from that. And so I'm going to bring up a QR code around that. So that is based on $100 if you book that. But also, if you would like to either catch up with Sam and the insurance team, we thoroughly recommend reaching out to us as well. You can also do that via the same QR code, and we can arrange for a complimentary insurance consultation, because I've done this 3 times this month and I'm like, must go and get my insurances checked because it's been a couple of years and it is things do keep changing, and really there isn't anyone that shouldn't be getting their KiwiSaver just rechecked, because we are going up to 3.5% on the 1st of April. And I said it to a team today. It's kind of like we're coming to daylight saving and it's time to change our batteries and our smoke detectors. And I feel like the KiwiSaver change is a good opportunity to just check you are definitely in the right fund, on the right, doing the right contributions, and definitely with the providers that are giving you, the best kind of setup. And so Jay and the team would definitely be happy to look at that and any other investments that you're kind of working with. So yeah, on behalf of the team, Shelley, Jay, Sam, and myself, thank you very much for joining us tonight. And we look forward to catching up with you in the future. So good night, everyone. See you later.
Good night. Bye.